Over the Mother's Day weekend here in the United States, both US officials and Chinese officials met to put together a trade deal. And I put in quotes, a deal for now, because all it really is a rollback of the retaliatory tariffs that each country put on one another. And it's done over a 90-day period. It is definitely a positive sign for the world in general and certainly the market, as long as the trade war tick-for-tat tariffs remain off. The deal, in essence, brings the U.S. tariff on Chinese goods back down to 30% and the China tariffs on U.S. goods down to just 10%. The facts are the following. It is just a pause right now and a rollback of those retaliatory tariffs. And as it stands, the U.S. tariff is much higher than that of the Chinese tariff on U.S. goods. So although both sides are going to go back to their countries and tout victory, right now it seems like a small victory for the U.S. After all, China produces billions in products that are sold to the U.S. China relies on our consumer economy, and their economy has been struggling since the pandemic, and it's been hoping to get out of the rut that it's been in for a number of years. So in all respects, they rely very heavily on the U.S. economy. The U.S. also, though, relies heavily on China, although many countries has been moving a lot of their manufacturing to other countries, countries like India. Both countries need one another. As such, with this latest news, we're going to be talking about in today's video what I'm looking to buy based on the current deal that's in place. So make sure you stay tuned to see all of these stocks that we'll be talking about. And in the meantime, show your appreciation by simply clicking that like button down below. Subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, let's jump back into today's video, taking a look at a few positions I'm looking to add to my portfolio. Some of them are already within my portfolio, so I would be adding to those positions. Beginning with stock number one, which is going to be Bank of America, stock ticker BAC. And when it comes to banks, I usually stick with the big dogs. Larger, the better for me. And the largest are Bank of America and JP Morgan. I prefer Bank of America. It's one that's been in my portfolio for a number of years. And in fact, although this may be a little controversial, I believe that Bank of America has a better management team, a better leadership team. However, they are the second largest bank in terms of assets, trailing only JP Morgan. The company currently has a market cap of $327 billion, and over the past 12 months, shares have climbed 13.5%. Year to date, shares are pretty much even, down just 1%. There's a few reasons to be bullish on the finance sector here, with this trade deal now, hopefully, behind us. The first is hopefully consumer spending can stick in there, and with higher consumer spending, that could bode well for loan growth when it comes to the banks. The second could be less regulation. Last week, a report came out regarding the administration's focus on cutting over 2,300 regulator-focused jobs. And the third is going to be around business loan growth, because now with this trade deal presumably behind us, it could give businesses a little more certainty about spending. And when they're willing to spend, that could be an uptick in loan growth. All of this could obviously change, but right now, given the facts, Bank of America looks very intriguing. In the company's most recent earnings report, management noted solid top line and bottom line results, with revenues growing 6% and earnings growing 18%, along with deposit growth reaching nearly $2 trillion, marking the 7th consecutive quarter of expansion. When banks receive more in deposits, this allows them to put that money to work to generate higher profits, higher net interest income. And with interest rates expected to remain elevated or pretty much flat now moving forward, not as many rate cuts priced in, that's going to increase the net interest income that much further, allowing them to surpass analysts' expectations, in my opinion. When it comes to valuation, analysts are expecting the company to generate 2025 EPS of $3.64 per share, which equates to a forward PE multiple of 11.5 times, slightly below the company's 5-year average of 12.1. However, when it comes to big banks, price to book is a better metric to look at, where it's pretty much trading flat with its 5-year average. Right now, price to book's at 1.1, 5-year average is 1.2. Bank of America also pays a growing dividend, one that currently yields 2.5%. They have a 5-year dividend growth rate of 8% and 11 consecutive years of dividend growth. Analysts rate the stock a strong buy with an average 12-month price target of $49 per share, implying 12% upside to go along with that 2.5% yield you get as well. And that leads us to stock number 2, which is going to be Amazon. Stock ticker AMZN. Amazon is a name that I continue to pound the table on. And if you've been watching prior videos where I talked about Amazon, your returns are probably pretty good if you've been following along. I was talking about Amazon in the 170s being a blue light special. And for those of you that don't know, or maybe too young to know what a blue light special is, that's all right. Amazon, though, with this trade deal, is going to be a huge benefactor. Why? Because a lot of the products that they sell, a lot of the third-party sellers, are all from China. The company did, however, find themselves in the crosshairs of the White House for a brief period when they were going to put tariff pricing impacts on site, but that lasted about a few hours until those plans were scratched. The company currently has a market cap of $2.2 trillion. Over the past 12 months, shares are up 12%, but year-to-date, still down 5% and down roughly 15% from recent highs. Amazon is yet another company that has a lot of levers to pull. And even if our US economy did in fact fall into a recession, Amazon was still a name I liked because of this reason. They have a lot of revenue drivers, whether it's cloud, e-commerce, advertising, subscription, digital, and yes, even AI. Foundational positions at the top of your portfolio should mirror companies like Amazon. Very diversified, not a company that's solely based heavily on one product or service. In terms of valuation, the stock isn't as cheap as it was a few weeks ago, but one we are looking forward to adding. Analysts are looking for the company to generate 2025 EPS of $6.20 per share, giving them a forward PE multiple of 31.1 times, and they're expected to earn 20% growth over the next 2 years. However, the better metric I like to look at is EV to EBITDA, where the company currently sports a 16 times multiple, still well below their 5-year average of 24.5 times. This is a company not yet getting the credit for the amount of EBITDA they're generating. Analysts rate the stock a strong buy with an average 12-month price target of $240 per share, implying 15% upside from current levels. This is a position that will one day be the largest individual stock holding in my portfolio. And if you want to see my entire portfolio, stocks I'm buying or selling, then definitely consider becoming an Edge Plus subscriber, where you get to see my portfolio, get trade alerts, get access to my monthly members-only meetings, and so much more. Check out the link down in the description below. And that's going to bring us to stock number 3, which actually isn't a stock at all. It's an ETF, and that is the Schwab US Large Cap Growth ETF. Stock ticker SCHG. So with a lot of these trade tensions looking to simmer down, at least for the next 90 days, this could bode well for a lot of growth stocks, as we could see a big rotation. Because what did we see when the tensions were higher? We saw a rotation out of a lot of these growth names. Now we could see a lot of that rotation back in, which is going to benefit an ETF like SCHG. There's no need to try and pick the winners. You can pick an ETF that has many high-quality, large-cap growth positions. This is an ETF that is dominated by technology, with nearly 50% of its exposure to that sector, followed then by communication services and consumer discretionary, rounding out the top 3. The top 10 holdings include Microsoft, Apple, Nvidia, Amazon, Meta, Broadcom, Tesla, Alphabet, Visa, and Alphabet Class C. In total, the ETF has 229 positions, with the top 10 accounting for nearly 55%. So again, when it comes to SCHD, you got to take a hard look at your portfolio. If you are already overextended in a big way to technology, this may further push you over your skis a little bit. So it may not be for every investor, but if you don't want to worry about picking the winners right now and you don't have a ton of cash, why not put it in SCHG, where you get a lot of high quality, large cap growth names. This is also a position that when the trade tensions were starting to rise, I sold out of and saved myself a lot of money. Now with those trade tensions down and hopefully bringing a little bit more clarity and less uncertainty for both investors and businesses, again, it can bode well seeing a rotation back to these high quality growth names, meaning I'm looking to get back in to SCHG. The ETF currently has assets under management of $38 billion, and over the past 12 months, SCHG has climbed 16%. Year to date, though, they're down 3%. You also do get a bit of a dividend, but again, that is not the focus whatsoever. So there we just looked at 3 different positions that I'm looking to add to my portfolio. Now that we have a little bit more clarity, less uncertainty for both investors and businesses alike moving forward. In the comment section down below, let me know which of these 3 positions would you be willing to buy right now. And make sure you join my Discord, the Stock Investor's Edge. There's a link down in the description below. We would love to have you there. And if you haven't done so, hit that like button down below. It's truly appreciated, and we'll see you in the next one. Take care.